Ah, the infamous irrational exuberance comment. That very man joins me right now, former Federal Reserve Chairman Alan Greenspan. And Dr. Greenspan, it is good to see you again. Thanks so much for joining us.
My pleasure.
And of course, you foresaw what was to occur in markets long before it actually happened when you said irrational exuberance. Mr. Chairman, do you see similarities between today's market and what you saw back in the late 90s?
Very little. There is no irrational exuberance that I can see. In fact, it's the opposite at this particular stage. Nonetheless, we still have got a situation in which risk premiums are not all that out of line, and I would not be surprised to see stock prices rising, but not in any pace that could be termed irrationally exuberance driven.
Okay, that's good to know. But at the same time, you've always looked at the so-called wealth effect, right, and what that means for economic growth. And I know that that was an important indicator for you. In terms of the wealth effect today, we were seeing the stock market up 16% since Election Day. We're seeing a number of, technology names at their highs. Has that impacted broader economic growth, that wealth effect? People feeling richer, so they're spending more money.
Oh, it invariably will. Whether they like it or not, that's the way they behave. People have always behaved this way, and when you get stock prices moving up, or capital assets in general moving up, it does impact consumption expenditures.
So far, the consumption has been weak. You've got spending out at the end of this week up 0.1%. You've got the retail sector that's totally bifurcated. Amazon.com taking market share and malls going out of business. How would you characterize economic growth today? And what are the chances that we get to 3% growth over the near term? Steven Mnuchin, our Treasury Secretary, is betting on it next couple of years.
Well, I think the second quarter is going to show a 3% change, but it's a little deceptive because we're having a problem with the seasonal adjustment factors between the first and the second quarter, and as a general rule, I tend to average them, and the average is significant. Remember, the average is 1.4 and say 3.0. That's not a terrific number as far as GDP is concerned, but it in turn is exactly what you would expect at the levels of productivity growth which we have now been experiencing for a number of years.
I had an opportunity to talk with Allianz Chief Economic Advisor Mohamed El-Arian this past week on Mornings with Maria. He said that the central banks are losing influence. We're looking at fiscal policy for the real impact. Here's what he said to me. I'd love to get your reaction, Dr. Greenspan. Listen to this.
They've conditioned investors to believe that central banks are their best friends forever. But what we are seeing on the ground is that the effectiveness of central bank policy is declining. And that's because there's only a limit beyond which you can't simply build a bridge to nowhere. At some point, you've got to build a bridge to better fundamentals.
Yeah, that's good.
And that's why central banks need to hand off.
What do you think about that, Mr. Chairman? We know that Mario Draghi and company in Europe, they are suggesting that maybe the stimulus comes to an end soon. We know what's going on in the U.S., the Fed raising interest rates. How do you respond to what we just heard?
Well, I always thought that Mohammed is thoughtful, and I think he is in this case. We rarely disagree, and this is not one of the cases in which we disagree. He's right on the money.
Will fiscal policy, if we get it, move the needle on economic growth, do you think?
If we will get it is the question. But you can't get growth going so long as entitlement expansion is anywhere near where it's been recently. It's eating up the sources of investment and the sources of growth, and you can't have it both ways. You cannot fund all of the entitlements everybody wants and expect that you're going to get a GDP out of that of 3% or more at an annual rate.
Yeah.
The arithmetic just doesn't work.
Yeah, you're right. And that's why they are actually trying to slow down the growth of Medicaid involved in this bill right now.